the next time we get like a 3-4 standard deviation type correction in a principal macro asset class, I'm buying it. I'm damn buying it.
I'm glad that I'm 1,000 miles away from Hugh because he might punch me at the moment. But
higher interest rates are literally doing the opposite of these governments' renewed.
Notable deval of CNY in the first quarter of 24.
Yeah.
Albert's told us before that the Fed hates regional banks and they hate smaller banks. Why is that, Albert?
because it counteracts any type of tightening policy that they're implementing. I mean,
We love to be green, but if it's going to cost me an extra $1,200 a year, thanks, but no thanks.
I still hold to this, that over the next 12 months, you will see the Federal Reserve cut rates very, very rapidly.
I suspect we already know what it is. It's just a matter of us allowing it to break and the timing of it.
Yeah, okay.
Yeah. You don't accept that.
No, I
Hi everyone, and welcome to the week ahead. I'm Tony Nash. Today we're joined by Hugh Hendry, Tracy Schuchart, and Albert Marco. We've had a big week with the Fed meeting and the press conference. We've had some results come in. We have some relief in markets the back half of the week. But there's some pretty critical things we want to talk about. The first thing I want to talk about with Hugh is banking. He's talked for the last year about deposit flight and banking and potential for deflation in 24. So I want to talk through that. Tracy's talked quite a lot this week about the wind and solar kind of models being broken. So we're going to talk a little bit through that. And then we're going to talk about the melt up in equities with Albert. So that's a little bit sarcastic. So let's get there. We're having a quick promotion for our CI Markets platform. This is our platform that forecasts currencies, commodities, equity indices, individual stocks, and global economics. Right now, you can get 40% off a prepaid annual subscription. It's a limited time deal. That brings the price down from our normal $500 a year to $300 a year. Visit completeintel.com/save200. Use the promo code SAVE200 at checkout. To start, Hugh, thanks for taking the time. I really appreciate this. You're in a beautiful location and we're all jealous. So you've been talking about deposits flight since Q2 from US banks. And of course, this happened because of the duration risk at commercial banks when depositors moved money to money market funds and treasuries. We're still seeing deposit flight. According to Fed data, this is on a year-on-year basis through, I think, last week. The gap appears to be narrowing a bit, but how stable is the U.S. banking system given this deposit flight? Can you kind of talk us through a little bit of
that? Well, it's a global issue, okay. And it really relates again back to there are two agents within the economy, which have been caught out, if you will, with the Fed's very aggressive hiking cycle for the last 2 years. One being the Treasury, and I think the legendary Stan has been out for the last 10 days or so, lamenting on the Treasury's decision not to extend maturities. And of course, the other one was the banking sector or the wider financial sector, because there was something extraordinary in that period, late 2020 and all of 21, when the majority of the private sector refinanced their rates. And of course, that made the Fed's rate hiking somewhat impotent, or it certainly took a lot of time. And I mean, we're still digesting the 4.9% annualized growth. So it took a lot of the potency of historic rate hikes out of the thing. But there was a transfer of interest rate risk within the community. So the household sector and corporates have been spared. And of course, that was then put on the balance sheets of insurance companies and those buying treasury bonds. The long dated, the US treasuries has been trading as low as 50 cents on the dollar.
Mm.
So the capital flight was twofold. Mostly it is the income arbitrage, why accept there's still trillions of dollars on sight accounts earning basis points.
Mm-hmm.
And slowly but surely people need the money and they either go to their internet account or they do something about it and they transfer. That's flight. And then the other issue is, the impairment. A bank essentially is a hedge fund that either owns treasury bonds or kind of these index-linked securities called loans to the private sector. And we've seen a big impairment on the government bond holding. We know officially that's $500 billion, I think, more than $500 billion. And so that could motivate a credit flight. That's been very, very modest. That was only there in March of this year. But of course, here we are. And a lot of smart folk are getting really concerned about a slowdown in Q4, Q1 of next year. And we've yet to really see cyclical credit charges rise within the banking sector. So it's in flux. The regional banks are trading at 40-50% discounts to NAV, which is a reflection of that uncertainty. And the only thing is perhaps that uncertainty is going to become less as we roll into the months and quarters ahead. But you'd imagine that the story is going to be kind of adverse.
Sure. So, we've heard people talk about credit events and these sorts of things. You say the uncertainty will become less. Do you think there's a possibility of a credit event in the near term, or do you think we're largely past that?
I do. So when the big thing in my world is Stan Druckenmiller. Stan
Sure,
he's a god.
Yeah.
Just does. And I feel very uncomfortable because I differ from Stan in that I still believe in the prevailing cyclical behavior of our economy and the major participant being the Fed, which is to say that this leveraged economy, which needs more and more debt really as the dynamic for incremental GDP growth, by repricing the debt dramatically higher, I've been of the view that there would be a kind of systemic economy-wide credit event, and I still hold to this, that over the next 12 months you will see the Federal Reserve cut rates very, very rapidly and head back to zero. And then in that 12 to 24 month period, we might be talking about the Federal Reserve's balance sheet again, moving to 15 or 20 trillion dollars. So I still think there's one last cycle of that nature. Stan's like, no, they can't do that anymore. And again, but that requires, your central question in the thrust was the credit event. I'm assuming a credit event. And then lastly, I'm assuming a global credit event, because again, the private US sector largely vaccinated itself against the Fed, but overseas agents and primarily the Chinese government and the Chinese serial kind of fake-ish GDP thing, if it worked, the transmission was zero Fed rates. Yeah. And it clearly doesn't work. And so the fear that I have more widely, and the need for the Federal Reserve to come back down to the kind of ZIRP region, would be a further profound movement, especially in the cross currency. You're seeing it with the yen, and then the Chinese yuan really seeing the anchor around the 730 and heading closer to 8, if not in the direction of 9. I think that would precipitate enormous need for the Federal Reserve to change tack dramatically and aggressively.
Right. So let's talk about China for a minute, because Albert said, I don't know, 6 or 9 months ago, that if the Fed heads to 6, China is going to be in a lot of trouble. And we're at 5.55 right now. So why, from your perspective, why does that cause problems for China? I know we have this big real estate issue in China. We also have commercial real estate issues here in the US, right? So why is Fed policy such a big problem for China right now?
Well, it's the global overvaluation of everything. Yeah. For property, we could just as well discuss, the private equity industry, and these are trillions of dollars large. The last 15 years, Professor Michael Pettis out of Peking University calls it the bezel. We sometimes fraudulently, but in 90% of the cases, we just mistakenly over-egged just how rich we were and how good the prospects were. And so assets typically at the economic level match the liabilities. Yes. So asset values are inflated, which allows a huge amount of debt to GDP. So it's a collateral. And when you start to see collateral in.
Sorry, just a second.
Then, you have to, again, oh, heavens, you lost me a bit.
That's no, right. We got you back. We got
you back now.
Okay, forgive me. So really just let me check if it jumps my Wi-Fi, it should be working. Anyway, so the impairment of assets and the need to distribute wealth from the Chinese have pursued that years, and they've robbed the wealth of the consumer. And now it's a question of just how much more they can rob the consumer of their wealth, because you're seeing it in very severely low sales figures, like private consumption. So the consumption to GDP, excluding the government sector, is astonishingly low. So,
right. So
the ability to bring,
you talk about, assets being valued very high. We have that in the US with real estate prices right now. We have that in China with real estate prices. Even though things have come off a little bit, I think the hope with rising interest rates was that some of those real estate prices would come down, both here and in China. We haven't really seen it that much. Albert, what do you think? What's the problem? Why are the prices so sticky right now?
Well, I mean, first of all, you have cash buyers selling from up north and buying in the south. And on top of that, you have people with 2% and 3% rates that simply don't want to or can't move to any other homes at the moment. So there's no inventory, and it's keeping the prices artificially high. It's a political problem both ways, because the boomers have a lot of cash in the real estate market, which they don't want to give up. But then you have the youth vote, where they're crying that they can't afford a home, and they're still living with their parents, and it's a problem both ways. And I don't really see how it gets resolved, to be honest with you. As long as you have those cash buyers willing to step in on any type of dip in the rates, I don't see housing in the United States really crashing per se.
Okay, and so do you guys see the Chinese government allowing the valuation of real estate to fall dramatically? Because that effectively takes the savings that Chinese consumers had, and if they collapse real estate prices, then a lot of that saving that the Chinese had really gets disappeared overnight, right?
To be honest with you, it's over my pay grade, because to try to figure out what the Chinese want internally and how it affects their credit rating and their leveraged loans and politically, it's just it's too hard for me to even think about.
Hugh, what do you see there?
Well, on both fronts. So with regard to the US, I would say if rate, I think it's pretty obvious what happens. If rates stay at this level or higher, property prices and other risk asset prices, I think, could fall 40%, especially in the property. Or rates collapse very rapidly, and therefore you don't have that 40% reduction.
Okay, so you're expecting rates to fall pretty dramatically in 24. So is it kind of like this? We've got a huge demographic of people who are, say, baby boomers, and they're voting, and they don't want their wealth to disappear. So, and we've got all of these commercial real estate loans that are being marked down pretty dramatically. So the Fed will have to reduce rates so that big voting block of boomers doesn't lose wealth, and so that commercial real estate valuations don't fall dramatically. Is that, and that kind of saves the banking system? Is that kind of where you're going?
I guess where I'm going, we've got all of those zombie real estate loans. We've got all of those bank holdings of treasury bonds trading at an enormous haircut. We have presently the cyclical credit cost in the bank P&L is really, really low. And then finally, we have the diversification model blowing up. Like everything correlated, the 60-40 equity bonds thing, everything is correlated. And my guess again is if we just stay at this level, there's going to be a big reveal. There's going to be more of the March episode where we're going to see corpses, and then I think we're going to see the economy just seize, and the seizure comes rapidly.
Right.
Bankruptcy in Hemingway. On the China front, regardless of the painting the tape, if you will, by the authorities, Chinese property is, the Chinese Communist Party, we've determined that prices haven't fallen, let's say. Their problem is the people have marked it. They're like, oh merit, it's way below, and it's not producing anything. And we've, it had the luster because in people's heads, mentally, they had it, they were factoring in, I don't know, 7 to 12 to 15% annual price appreciation. And now they're like, it's zero and it's probably negative. That's huge. Not the only power, but a very powerful force available to the Chinese administration is to revalue the property in dollar terms. That's a very effective way. And you could say, oh, the domestic population don't see it. They only see it in renminbi. And that's the kind of scenario that takes you to kind of like a 9, requiring a 9 to the dollar. And that's profoundly deflationary. And so that would take you into the zero interest rate. And I just think, I've been talking about this for 2 years. I'm running out of rope for that talk. This is a kind of first 4 months of 24. We got to see it. That's my expectation.
So you expect notable deval of CNY in the first quarter of 24?
Yeah.
Okay.
Yeah.
Okay.
And that's very tied to where we are just now. And it's all coming out of Tokyo, and that hitting the 150, the dollar yen. And heavens knows, I was at the boulangerie in Gustav here. I was having my chocolate croissant, and I was like, there was news out overnight. The Japanese government, like, we got our polls are down. The good folk are taking in the ass with price inflation because the yen's been very weak. And they're like, hey, we had this great idea. We're going to have a supplementary stimulus package. We're going to spend, I don't know, $200 billion or whatever, And I thought, what is, so my life is, I ask myself questions. Why is the sky blue? What is the primary surplus deficit in Japan? I kind of should know, but I was like, you got to revisit that. And really, really, really fast. It's huge. Their deficit enormous, and they keep adding to it. And remember, the Japanese 10-year is 91 basis points, roughly. Yeah, it's what we hit 500 basis points in the US, 500 basis points if you put, and with short rates in the US being 5.5, being minus 20 basis points in Japan. Japan's interest servicing in terms of its lien on the budget 7.7%. So, and the US is at 4.4. I mean, imagine Japan really, heavens, the world is in a perilous place, but for all the peril, for the good folk watching this, just got to say the S&P is a remarkably robust institution. It may be reliant on those 7 stocks, but it's also reliant on that flow that comes in all the time. So, you know, when I say I'm looking for a credit event, unfortunately, we live in an over-leveraged environment where that's possible, and it's happening with more frequency than 100 years of data would suggest. And that again speaks to just the quantum of debt that's outstanding. But if it has to be now, it has to be, here we are in November, and I'm still talking about this in April, closes me down.
Yep. Hey, Hugh, what else? I mean, you always take a very different perspective on things. What else are you thinking about right now as you look at markets? What are the big pain points that you're seeing right now?
For all that I've said about the rates coming down, the major drama of today is that the kind of what I call like the crazy faction, the Peter Schiffs of this world, might, like the whole dollar being dethroned. I was lamenting there on the perilous nature of the Japanese fiscal balance sheet, and of course Druckenmiller's and everyone else will tell you that the problems of the thing just stopping, the entitlement, the inflation, which was a kind of 2035, 2040 thing. It's like, come on, we've got to start answering it now because it's getting closer. But with the rate rise, we're talking about it being 2025 to 2027. That's an environment where that would be kind of 100 years since the denouement of the previous global currency regime, the gold regime, which eventually gold was replaced by dollar treasury bills. And again, we're coming back to this notion of impairment in the reserve currency asset and what happens. And so I'm doing a lot of thought about, if the whole thing breaks down, what do you own? A lot of people previously have said, well, you would own the likes of Apple. But actually Apple doesn't work, because Apple it sells iPhones and services and it gets dollars, but we could be at a point where who wants dollars? You've been in an arbitrage world. So maybe, Bill Gates seems to be buying all that agricultural land. And actually, if I've got steaks, if I got cattle, that's not cash. That's something you actually need for life. So I'm kind of think, what do you own if you get profound impairment in the reserve currency asset? Is something that's occupying.
But I think that's the real question, right? Is what is it? If it's not dollars, what? And we've been talking about that here on this show for over a year.
Bullets. Bullets.
Yeah.
I'm all about hard assets.
Right, you are.
Heads up for a short break.
Are you using the potential of AI in your portfolio management strategies? With an impressive 94.7% forecast accuracy on average, you can confidently integrate AI into your approach with CI Markets. Visualize the potential volatility of your portfolio over the next 12 months and gain insights into specific assets that might experience fluctuations. This empowers you to make informed decisions on when to buy, sell, or hold. CI Markets covers a wide range of over 1,600 assets, including stocks, commodities, forex, indices, and economic indicators. Imagine running limitless portfolio scenarios to optimize your gains. Curious about the outcome of removing or adding certain assets? Wondering how your portfolio might evolve in the next 3, 6, or 12 months? CI Markets equips you with answers to these crucial questions. Whether you seek a streamlined portfolio analysis, wish to explore diverse scenarios, or aspire to track your investments with precision, CI Markets is the ultimate tool for you. Ready to learn more? Visit us at completeintel.com/markets.
Thank you. And now back to the show.
So Tracy, you put out a tweet earlier about because he was talking a little bit about an event and some difficult things and difficult trade-offs. During the Fed meeting, you tweeted out where Powell had said the Fed has been working a lot with financial institutions to make sure they have a plan for how to deal with unrealized losses. Okay, so if we're seeing this credit event, you tweeted this out saying, read, taxpayers prepare for bailouts. So what do you think about the magnitude of that? Do you really think this is coming? Do you really think bailouts for more banks is coming?
Absolutely. I think we're still set to see a lot more consolidation in the industry, right? I mean, we have still a lot of small banks in the US, like 4,500 small banks. We are seeing more and more consolidation. I think that is set to continue. I don't think anything, I don't think what we saw earlier this year with SBV and that sort of mini banking crisis is set to end. I think that we're still going to see problems within some of these smaller banks, especially with what they are exposed to. I mean, Moody's even came out and said that some of the smaller banks are sitting on, $650 billion worth of unrealized losses right now. So I think that is going to be a problem for smaller banks, and I think we'll see further consolidation. And this is nothing new. This started in the banking crisis of 2007-8 with the fall of Lehman Brothers, right? And we saw a huge consolidation with the larger banks. And so I think now it's going to be bigger banks swallowing smaller banks.
More of that. And Albert's told us before that the Fed hates regional banks and they hate smaller banks. Why is that, Albert?
Because it counteracts any type of tightening policy that they're implementing. I mean, the regional banks will do what they're going to do because, they're at the forefront of mid-sized companies issuing loans out. So, I mean, I know they don't like them. I think what Tracy was saying about bank consolidation is probably right. I think what Hugh was saying about the credit issues is right, because I from what I've heard, Bank of America is insolvent. And that's a looming problem that I don't think anybody's really talked about or addressed. Or you want to talk about a Lehman moment? Imagine if B of A crashed,
right?
They would have a problem there. So I mean, it's just that's something I'd want to certainly keep my eye on in the next 6 to 12 months.
Yeah, but okay, let's say that's true, and I'm assuming it is. Does it surprise anybody that a systemically important bank is insolvent? I mean, they're backed up by the U.S. government, right? So do they really have any worries?
Well, the worry is the what do we call it? Disintermediation. It's the banks sponsor and spread economic vitality via the credit transmission. Yeah.
Yep.
And so the impairment and them not feeling good about their world means that they are not risk seekers. And banks get it's hard being a bank. Everyone hates you when you're a bank. Mm-hmm. They hate you because you take too much risk or you take too little risk. You can't really win. But we're in an environment where they're not volunteering to take risk. And that just tends to mean that at the margin, the economy will suffer. So that's not a good thing.
Small companies suffer, mid-sized companies suffer because they can't borrow, right?
Indeed. And then, but it's more than that, because we can go again esoterically into this matrix-like world of the Eurodollar system. And Jeff Snyder, who just the kind of is the locus of all knowledge about the Eurodollar system. He thinks it's broken. I don't think it's broken. I think it's just that system which creates unregulated lending and with infinite leverage is not showing up. That it's not excited either by the remuneration or by the risk reward payoff from extending new credit. And so again, we're in an environment where it feels very fragile. It can break. And we've just gone through the most preposterous attempt to restart the credit mechanism via the IPO window, and you look at and they just, it's like the scorpion being carried across the river by the frog. Halfway over, and the scorpion kills the frog. It's like, dying, croaking words. Why'd you do that? Because that's who I am. It's like, why? That's really the best companies? Birkenstock, Arm, which is just a huge plaster on SoftBank. I think SoftBank is a zero company in my world, and that was a desperate attempt to to stave off bankruptcy, and the market saw through it. So I see credit just being pulled and yanked away everywhere. But then, so how my mind works is I work with irony and paradox. So the world's greatest investor, Stan, and the world's second greatest investor, like someone like Jeff Gundlach, right? They've worked it out. Within 3 to 5 years, the US Treasury system model doesn't work. It stops, and it stops because of where rates are. It stops because you've got a debt multiple. The debt is a multiple of GDP. That you're running deficits, so you're having to borrow more and more every year. And so it becomes like this S curve. And they've said, this thing breaks. The dollar breaks within 5 years. Okay. And so they're like, and they don't, and so Stan is like, yeah, I've really bought a lot of 2-year, but I can't see how the long end of the market comes down. So my mind's a mess, but I work with drama. I think everyone kind of takes their intellectual leadership. Everyone is very fearful. We've seen the bonds trade there. They're getting a rally to 4.5. But we'll see. I just think that the bond bull market that began 40 years ago in 1982 will end in that spectrum that Stan imagines with the Treasury. But the people who are either shorting or saying, yeah, I won't own bonds, will be the ones who own it when we get that credit event. So my idea is, if you look at TLT, it fell from 180 to 80.
Yep.
Decline, yeah. I think it can go back to 140 to 160. And in that environment, I want to be short it, Markets are like, they give you drama and irony. When we started the bull market, we were in a profound recession with the Fed hiking rates. And from early 1981 to the summer of 82, if there was anything going on in your mind, you had to clearly see the visible trace of inflation declining. Michael Steinhardt bought bonds, he bought treasuries, and he was sued by his clients. Like, that's the crazy stuff. So I'm expecting a crazy kind of very sharp halt in the economic progress of the US, and where it becomes less of an outlier and it joins Europe and China with their travails. The Fed does something very, very dramatic. And then fast forward 2 years and we're talking about, hey, listen, the Fed's got a $20 trillion balance sheet and the Treasury model doesn't work. It's the end of the dollar system.
Oh,
thank God it's the weekend.
Honestly, that's the most, that's the most plausible scenario I've heard about the end of the dollar system, Hugh. I mean, I hear about CNY and other currencies and commodity-based currencies and all this other nonsense, but the Fed doing itself in is the most plausible scenario I've heard. Albert?
Yeah, of course, that is. I mean, the issue I have with this is a Yellen versus Powell conflicting policies that's ongoing, that's causing a bigger problem. I think Yellen's actions certainly would shorten the lifespan of the dollar without question, and you can see that. But I mean, Powell was pretty clear that if long rates were to suddenly fall because of Yellen, he'd have to step on the gas and tightening again. I mean, that's the only hawkish thing I've heard about, during the Fed minutes. I mean, maybe Yellen can get us to 4.7, but that's going to be hard beyond that. It's just not going to be enough this late in the cycle to get us, to get the, equities, where she wants them for political optics, in my opinion. I mean, they're definitely going to have to use the dollar, take it down to like 100 to rally a market. But that's just my opinion.
They've had some good progress over the past 24 hours, right?
Yeah. Oh God, yes, they did. We were at 4,400 October 18th, 19th, whatever it was. I mean, it was a couple weeks ago.
Yep.
It's unbelievable what they've done.
That's right. Okay.
I think you give them too much credit. I think these things just happen. But on the dollar and this nonsense that it's going to be other countries that take it down. The dollar system ends when it's rejected domestically by the US. When the US says this is not working for us. That's how it ends. I think that becomes closer when if you, I mean, you've already seen a dramatic devaluation by the Japanese, and if that bleeds into the yuan, then the deflationary pressure will be so great that it's actually the US that comes and brings global leaders together and says, we got to think of a new way of doing this.
Yep. I think as you talk about Japan and China, I think, you know, the best proxy for what's actually happening in China, in my book, is Korea. And so we have to watch the yuan, the Korean won. We have to watch Korean economy to really understand what's happening inside of China. It's a microcosm, very small microcosm, I believe, and I've watched it for years, of what's actually happening in China. And so it'll be interesting to watch that play out.
Heads up for a short break.
Want to take control of your investments and predict the stock market? CI Markets is the self-directed trading platform that provides 94.7% accurate forecasts for over 1,600 stocks, ETFs, forex, commodities, market indices, and economics. With CI Markets, you can manage your own investments with ease and supercharge your trading experience. Sign up for CI Markets today and get 40% off your annual subscription with the code SAVE200.
Thank you. And now back to the show.
Okay, so as we watch the wind blow through Hugh's hair, and we all wish we were in St. Bart's, Tracy, let's talk about wind and solar for a minute. Okay, so
Nice segue.
you like that? So we saw some serious write-downs of wind and solar this week. First, on Wednesday, we saw Ørsted abandon 2 U.S. offshore wind projects. Kind of the estimated write-down was about $5.5 billion US. Ørsted is the largest offshore wind developer in the world, and they had already received about $1 billion of subsidies from the New Jersey government. So, you know, if Ørsted can't make offshore wind work, who can? We also saw Equinor write down $840 million for offshore New York. Both of those guys are blaming government delays and red tape. But I think it's a little bit weird that those companies that have benefited so much from government subsidies and regulation are now blaming governments for their losses, right? So, you know, I guess the real question is, you know, why is this happening now? Probably cost of money, but that's one of the questions I want to go into. But the irony, if we look at wind, is these next tweets that you put out, where one talks about Sunrun taking a $1.2 billion charge, which Sunrun is the largest solar installer in the US. And then in the very next, or the previous tweet, you talked about how coal hits a record in India, right? With 16.1% growth in September. So what's happening? Like, we're supposed to be in this green new period, and I know that you and Albert and I have kind of a bias against the viability of these business models, but I think we need to try to figure out what's really happening here and why are these guys doing these huge write-offs?
Well, I think at this point, you have to understand that first you have supply chain issues and all the things that existed before. Obviously, there's still inflation, but the core of this is rising rates, right? Because all of these projects take a lot of money and a lot of borrowing to make them come to fruition, right? And with rising rates, these projects become unviable, economically speaking, right? And with inflation rates and such as, so if you take, let's step back a few months when we go over Ørsted, for example, a few months earlier asked, or I think it was mid-October, sorry, they basically said to New York, if you want us to make this project viable, we're going to have to charge you 55% more per kilowatt, meaning you're going to have to pass this on to your consumer. Obviously, what are you going to do as a utility company? And the utility company just said, this is breathtaking, enormous. We didn't expect this whatsoever. And so they denied the request. And that's really what brought on them bringing down the write-down and said, okay, well, then we can't do this project. We're going to walk away from this. And so I think that you're going to find that happening more and more as these projects balloon in price, even with government subsidies. They're ballooning in price, and they're just not affordable without charging the consumer more and without charging the utility companies more. And nobody, even New York, which is about as liberal as you're gonna get, said, no, this is our red line on this project. It's going to cost too much money. It's going to cost us too much money. It's going to cost our consumers too much money.
Okay. So is kind of the Green New Deal and the green transition, all that stuff, really something that only works in a kind of a NERP and ZERP environment? I mean, is this kind of a canary in the coal mine of different types of investments and industries that we've seen?
Absolutely, I think it is. I mean, they will only thrive in that kind of environment. As soon as we see rates rise and these projects balloon in price, they become more and more economically unfeasible.
Okay, because the kind of the opposite factor of your coal tweet and your solar tweet was so interesting to me, because you just have to wonder, as interest rates are the cost of money, right? So as money costs more, we can't spend on these things like wind farms and solar and all this other stuff because the installation cost is so high. Are the running costs high? Maybe, maybe not. I mean, I think there's different data saying different things, but the really cheap cost of coal when money is expensive is really notable to me on a volume basis. Right?
Absolutely it is. And if we take, for example, what just happened this week is that we had the German economic minister basically was approached by one of their nuclear facilities that said, we can bring this back online, we can do this cheaply, we can, and they said no and opted for more coal because that was even cheaper than bringing that project back online. So we're seeing, higher interest rates are literally doing the opposite of these governments'
right.
renewed.
So you guys correct me if I'm wrong, but if I recall correctly, it was kind of 2008 and 9 after the financial crisis that Spain and Germany spent huge amounts of money subsidizing solar. And that really led to China developing a lot of their solar industry. Is that right? So
Yes. Yes, absolutely. Oh, but you said you guys, I didn't know who you wanted to answer.
All three
yes,
of you.
Absolutely. And here's the problem is, we've seen what's happening right now is I put out a tweet about what's happening in the US solar industry. And I got a lot of responses that said, well, just place tariffs on China, which we have, or ban imports altogether from Asia. Now, that's easier said than done, because if we did that, first of all, we're not that far down the supply chain enough, or we're not built out enough in the US to cover those needs yet, right? Manufacturing wise, we don't produce enough to cover our own needs at this point. And then we also have a problem is that if you cut these people off, you ban this, then you balloon solar project budgets by 10 billion fold. Right. And so you're pricing everybody out of the market. And we're not talking about, solar panels for your roof. We're talking about big commercial projects that are fed into utility grids.
Right. So, okay. So what does that do for, China makes more solar than anybody. They're the green leader. They're doing more EV cars than anybody. So as money costs more, how does that impact the ability of China to grow their green power generation sector?
Well, I think that, China's going to grow their green power sector, but you have to realize this is coming off of a very, very, very low base. So everybody's just looking at, oh my God, they've done, X amount, which is really just the rate of change, but it's not really the biggest part of their entire energy makeup. If we look at what they're doing, coal is still a majority of their power, right? And so they can take the rest of that, right? They have the thing with China is that not only do they have the minerals, but it's easy to produce there. Their permitting process is totally different. And they also process these minerals, right? Because it's not just digging them out of the ground, you need to process them. So they've got the whole supply chain already there, and they're 20 years ahead of us.
Right. So just for reference, and tell me if I'm wrong here, but I believe coal is still something like 74% of power generation in China. Is that right?
That's correct.
So all of these green products are being produced by coal.
Correct.
Okay. So go ahead.
Essentially, yes.
Okay. So Hugh, what's your view on this? You know, as green technologies become more expensive to build, those factories become more expensive to build, that sort of thing, what's the impact on a place like China? Because, you know, we just talked about Chinese currency having to deval, all this other stuff. Do you think there's a major impact on China and their kind of position as, you know, the ability to produce green technologies?
Well, I thought you were on a pretty sound footing with the cost of money and the engagement with the green technology. Whilst, of course, indigenous or domestic sources of energy are very much from coal in China, at the margin in terms globally, China dominates solar panels. You know, the Europeans, you know, had a goal, but we have a goal. Our economic models require investment on the basis of a return on investment, and the Chinese have a different system, again, which is predicated on the Fed being at zero.
Yep.
You know, the Chinese system creates GDP growth, not wealth, because it doesn't require the reciprocal of a return. You know, with the big issue that we had with the Huawei or no way, you know, the cell station software companies like Ericsson, Nokia, those stocks have disappeared. They're still quoted, but they've fallen 90% in the last 15 years because there's just no economic vitality, no return, no profit return. Whereas the Chinese dominate it because they're like, we strategically want to own these areas, and so they will own those areas at the expense of a return. And that has serious repercussions for the rest of the world. But for sure, the great capital cost of implementing these huge green schemes into electrical grids in the West, they do not work with the present price of money. And then I have to confess, I've been so grotesquely wrong on the uranium sector. And when I say, I mean, I've wanted to participate. I've participated in uranium bull markets. And again, I'm suffering from too much drama. People get it. You know, Cameco, I think was it this week or a week ago, they had results. Stock was zooming. I mean, you know, people talk about the Magic 7 and the S&P. I mean, look at those uranium stocks. Incredible, right? Yeah. But, you know, I was going to push it back to Tracy or Albert. The capital cost of a new nuclear scheme, right, keeps going up, and at the present interest rates is really, really hard, and it requires an increasing tariff subsidy from the government, which is it's unwilling to give it for solar and wind. Is it more willing to give it for nuclear? I'm not so sure. What's keeping it going? Question.
I don't know. I mean, from personal experience, I was not nuclear, but for oil terminals, I had a colleague of mine who was looking for, you know, financing to build out a terminal for major oil companies, and this financing was minimum 12%. I mean, that's just not doable. I mean, that ruins the economics of anything you want to do, whether it be, you know, fossil fuels or nuclear or whatnot. It's just not conceivable, in my opinion.
Minimum 12% for an oil terminal. Imagine what
minimum
company
12%.
Imagine what small company loans are. I mean, that's crazy. Tracy, I want to come back to you on this. You know, we saw wage growth is slowing in the U.S. Consumers are starting to be fatigued. We're starting to see companies not able to push margin and price like they have been. Do you believe that U.S. consumers are willing, if say these green technologies are more expensive, and say the production costs are more expensive for electricity, Are
Absolutely.
consumers in the US willing to spend more to know that their power is generated by solar or wind or something else like that?
Absolutely not. There've already been a million studies on this. And if you're seeing utility companies balk at these prices, trust me, the US consumer has already said, we love to be green, but if it's going to cost me an extra $1,200 a year, thanks, but no thanks.
It's a nice to have.
Like as long as their power is on and they have heat and they have air conditioning,
right?
To be honest, let's be honest, the American consumer cares in theory, but it doesn't care when it comes to their pocketbook, right? It doesn't care when it comes to their budget, especially when you have inflation ripping. I mean, we can talk, food prices are still high, gas prices are still high, utility, I mean, still inflation is hurting the consumer. And so, obviously they're not gonna, it sounds nice at all, but when it comes down to it, and again, there have been a lot of polls and studies on this, that the American consumer is just not, if it's you are feeding my kid lunch.
And even the Germans are opting for coal.
And even the Germans are opting for coal,
right.
Which is completely crazy to me. But, that's a whole nother story. And we've talked about that often.
Many times. Yep. Okay, great. Thanks for that. Albert, let's talk about the melt up. We've seen it over the past couple of days in markets. They obviously turned since the Fed meeting. Albert reported fairly well on Thursday. We had 78% of companies beat on earnings this quarter. Yet, and it's hard to imagine, you put out a sarcastic tweet about a melt up, saying this was all rigged to crush shorts and squeeze back to 4,400. Good luck to longs thinking the melt up is coming. So why are you killing the melt up vibe?
I just, for me, the Fed and Treasury, they love long rates up here higher for longer because it's doing the dirty work for them. So they don't have to take the political blowback of, the markets crashing down or whatever problems that arise from it. Right now, I'm glad that I'm 1,000 miles away from Hugh because he might punch me at the moment. but I think in 2024, I think they rally long rates hard again. I think equities certainly aren't pricing in 5.25 on the 10-year as anything other than a passing phase. With rates rallying again, they bring down the equity back into a range of 4,150 to 4,500, which they seem to love to keep us in this range, to crush longs at the high and crush shorts at the
you're at the precipice of doom and hope, right? Right in there.
They've been doing this back and forth. It's silly. They've been doing this back and forth, and it's like killing money left and right. Portfolios are getting absolutely crushed. I've run through the numbers. I mean, the net buying required for them to move the long end is like the market cap of Apple. So it's not really that big a deal for them to move it back and forth. And that includes the 10, 20, and 30 years. So, I mean, it's just my bond take isn't really bullish equities simply because I think what they're using the long rate for the duration of 2024 to keep the market in check. And I think after the election, I don't know what happens after that because they don't really have the political restrictions involved.
Right. Let's talk about the Magnificent Seven for a minute. Everyone's favorite Jim Cramer came out and praised the Magnificent Seven. And you kind of talk about if we strip those out, the S&P is in negative territory. Can you tell us about those stocks and how they're used to goose markets?
Well, I mean, I've said this, for how many years? 3 years? That they used about a dozen tech stocks to rally the market whenever they felt like it. And I just think, this MAGA 7 stocks just going into the atmosphere whenever the markets seem to want to break down into the 3,900s or 3,800s it's a bit silly. I mean, how can you really look at this market with 7 stocks holding the whole thing up and saying that it's a healthy market? For me, I can't do it. I just can't do it. I need to see something where a credit event like Hugh talks about, or some sort of, bank breakdown or something happens where this corrects this market into like normal territory. Because I just don't like it, to be honest with you.
Okay, so what's normal territory? But sorry, go ahead, Tracy.
I mean, I kind of call this tech trade, this Mag 7 or FANG or whatever you want to, whatever the hot ones are today. Kind of the Pavlov's dog trade, right? It's the tech, it's that everybody wants to be in the tech sector since 2009. And that's all they could, you know what I'm saying? And so it's, they're just conditioned. Every dip gets bought, not realizing that we're in a completely different environment than we have been for the last.
And I don't think that rate hikes are to be done with. I think that, inflation comes back a little bit over in Q1, Q2, and I think they have to hike again. Could you imagine Powell hiking in 2024? What a disaster that would be.
I think you want to see it though.
I do want to see it. I like chaos. Might as well see it. It gives you some sort of opportunity, buy or sell, whatever,
Okay. So when you say take markets down to normal levels, what does that mean to you?
I think fair value is 3,800 in my opinion.
Okay.
3,600. That's just my opinion. Who knows?
Okay. So we could potentially see that in Q1. Is that
I think so. I would love to see that in the end of Q1. I would absolutely love to buy that going into an election.
Great. Okay. So
I see Hugh over there pacing.
Yeah,
already.
you and Hugh are on opposite ends of the spectrum.
I know. I was like,
I'm waiting for the onslaught.
Right. Come on in, Hugh.
The heavens. I was just looking at the so far interest rate expectations curve, and since, was it last Thursday when we had the 4.9 annualized GDP? The markets have now pretty much priced a quarter basis point cut from June of next year, at the margin. And you get it in the commentary of, the Bill Goss, Ackman, Gundlach, Stan, like everyone's back channel. It's something's just giving and breaking. So I'm in the market where I want to buy things. I always give people my confession. I get a bit of a razzmatazz because I made 50% in the month of October 2008, made 32 that calendar year. But my huge regret is what happened 5 months later, because 5 months later, at the end of March 2009, the S&P had fallen 60%. And I was on a train in China, a slow train. I wasn't buying that damn S&P. So I said to myself, the next time we get like a 3-4 standard deviation type correction in a principal macro asset class, I'm buying it. I'm damn buying it. And so I've been doing that via limited cost call options on the TLT TF, the ultra long. And the last 2 months have been, I've just stopped using Twitter, to be honest. It's just like
oh yeah.
But if you look at the charts and the bottom that we're etching into that TLT market, I'm kind of the next step is I want to physically I want to start buying more and more of it. But to move, I still maintain that for it to move, it moves, and it moves rapidly under duress, that something breaks. And that's just my gut. That's how I've kind of sensed the world works. But just to clarify, I want to buy things, but in a world where everything is overvalued, I kind of have to buy this grotesque pig-like entity of the US ultra long treasury. And my expectation is that it probably moves on the basis of some pretty ugly economic events taking place in the next 6 months.
I think we're all fairly uncertain, right? I mean, are we all kind of in that place where, I know Albert, you and Hugh are kind of on opposites, but I think I get the read that we're all a little bit uncertain.
Well, we are and we're not. I mean, I do think that this market has to come down, and I think Hugh does, also in some manner, fashion, whatever triggers it. I think we're pretty much on par there. We're just so overvalued. I don't, it's just how does it break, or what breaks? and does the Fed step in and make this, soft landing that they've, created the narrative of for the past, 2 years now. So
Right.
I just don't, I don't know. I don't know. I don't know what breaks
And
how
again,
it breaks.
and
Go
again,
ahead, Tracy.
see, and this is why this is one of my myriad of bases for owning hard assets right now. Just gonna
Yep.
throw that out there now because I'm the
Yep.
only one.
We'll play that back in 6 months,
trader
Tracy.
over here.
For me, it's just like they haven't fixed inflation, and if they haven't fixed inflation, especially with Europe and Asia completely like in a zombie status at the moment, I think there's going to be problems in the next 6 to 12 months. That's the basis of what I'm getting at.
Yeah, I suspect, and we'll close on this. I suspect that we already know what's going to break, but we just don't want to let it break yet. So that's my suspicion. And I don't think it's a big mystery what's going to break, but we all know what's going to break. It's just we haven't let it break yet. And when that happens, then all the things that you guys talk about is going to happen. Does that make sense?
Yeah, fair enough. Fair enough.
It's serious. What's the thing that's going to break?
Well, what have we talked about? We've talked about banks. We've talked about real estate, right? We've talked about Japan. We've talked about China. So, there's enough out there that we've talked about that can bring about some dramatic change. So I don't know that there's going to be some, mysterious thing that's going to come to the front and we're going to go, oh, we never thought about that, right? I suspect we already know what it is. It's just a matter of us allowing it to break and the timing of it.
Yeah. Okay.
Yeah. You don't accept that.
No. I think well said. Again, if we just take when the wheel stops, where does it stop? Let's say it stops on dollar yen. You've gone from something that traded 100, 110, now trades 150. Yeah.
Oh gosh, it traded 76 in 2012. I mean, the magnitude of the range of that is huge, right?
Oh, but the 76 was when you had the systemic, the tsunami, the nuclear thing and of that nature. Without that, and it was a very short, compressed, moment. That it was 100, 110 for 15 years. It's now 150. They're walking back the yield curve control. The movement in the 10-year again. These are standard deviation. These are irregular movements. And you're 90 basis points, and like I said, interest, and you've got the overnight rates are still negative 20, and yet the Japanese government's interest expense on that is almost 8% of GDP. I mean, and we're saying the US is within 5 years of breaking. I mean, where's Japan? And again, what I love about Japan, because my thing is irony, it's paradox. So Japan was the instigator of quantitative easing. They're this great bogeyman of of the conspiracists, the printing of money, which is really the printing of the capacity to print money. Japan's had to do it 27 different ways, and it still doesn't seem to print money. What if actually the Japanese quantitative easing, they actually found the resolve to print money? That they actually used all of those JGB bank reserves as collateral to borrow dollars and then to take term and credit risk into China. I'm talking about they did it silently in an invisible manner via the Eurodollar system over the last 15 years and probably powered and contributed to that S-curve in Chinese property. And then when the Evergrande thing went over, surprise, surprise, but that's when dollar yen, if you will, the yen strength peaked, and it's been downhill ever since. Now we're 150, and I feel like the famous words of Bruce Covenor when it was at 300 is like, call me crazy, but the market's whispering in my ear 100. It was 100, it's now 150. Call me crazy, the market's whispering 300. So like it's all there. It's in front of us. It's right there, right there.
Yeah, I really do think like it was well laid out here. I think we know one of the things that's going to break. And it's going to happen, and it's not a mystery. It's just the magnitude and when, and it'll happen. It'll happen. It'll happen in the next 3 months, 6 months, whatever. But it'll happen.
I think what we're saying is we can see a profound disturbance in the force.
That's a better way to put it.
There's a profound disturbance there. But what we don't know is how it reverberates.
Yep.
But it's going to knock something. And my estimation, we'll see it knock into the Chinese renminbi rate, and I think that's perhaps the most systemically important price level just now that the world is confronted with.
I think you're right. Guys, this has been amazing. Thank you so much for your time. Really appreciate the thought always that you guys put into this. So thank you so much. Have a great weekend. Have a great week ahead. Thank you.
Thanks, guys. Thanks, Tony.
Thank you.
That's it for this week's episode of The Week Ahead. Please don't forget to rate us and review on whatever platform you are watching or listening to this. Thank you.